Hello, everyone, and welcome to our budgeting and banking seminar, Tools for Better Organization. Let's go ahead and get started. I'm going to share my screen. Okay. So just a quick disclosure that the information in these slides are general information and not a promise of perfection or a cure to a person's situation. Here's information about who I am and my experience and qualifications. Feel free to pause the feed to read about me. So let's get started and talk about what my father calls the four-pocket theory. So what is the four-pocket theory? The four-pocket theory was created by my dad, Larry A. Brown, to explain the importance of developing methods, solutions, and best practices for financial survival by being prepared for foreseen or unforeseen life obstacles. So imagine you only have one skill and the skill becomes obsolete, or your job is being replaced or restructured, or worse, shut down. How will you continue to survive and pay your bills? So it's important that we continue to develop ourselves and make creative ways to earn more money and be less vulnerable. Some millionaires and billionaires do not or did not have a college education or various skill sets and certification. This is not the norm. However, those who have higher education realize that they have a better chance at employment opportunities at higher income levels than those who don't. Larry Brown breaks his theory down into multiple pockets within the four pockets. However, I've consolidated the necessary and important items he discussed in his theory into four pockets. So two in the front and two in the back, as if you're wearing a pair of jeans. The immediate pockets are in the front and easy access, where the back pockets are there to support the front pockets and offer more of a long-term strategy. And this brings us to developing income streams. So in the front pockets, you have pocket one. That's current employment, income, and skill set. So your main pocket is the first pocket, and this covers your current employment stream or employment, self-employment. So remember, having one skill is not enough today. You should have more to fall back on. And we'll discuss this in the third pocket. However, income generated from this pocket generally comes from your education, your mastery of skills, your certification, licenses, and your experience. The second pocket is your short-term assets. So an example of a short-term asset would be your savings account. These accounts usually do not earn much interest because they're easily accessible to the consumer. In times of uncertainty, it's more important than ever to have a savings account to back up your main pocket or your first pocket, until you're able to replenish that pocket with another job, another skill, or another trade. So to get started with this, what you want to do is open up a savings account at your local bank. And each time you get paid, put 10% of your income, of your net income, into your savings account. If you cannot go that high, start off with 5% or whatever percentage you can afford. The important thing is to remember is to put something in your savings account every time you get paid. Building a short-term savings account may take several months, and that's okay, because Rome wasn't built in a day. Just be persistent and continue to build this asset. Be patient. When there is an economic downturn in society, like it is right now, you'll have a pocket to fall back on if something happens to your current employment, until you're able to get another job or obtain another skill. And creating 6 months of living expenses, this can be difficult. There's nothing easy about this. This could take 1, 2, or 3 years, depending on how much money you make. But the important thing is be patient and continue and be persistent in saving. So let's talk about the back pockets. You have the third pocket, which is continuous development, and your fourth pocket, which is long-term assets. So experience, education, skills, and certifications are great ways to begin to cover the third pocket. It works beautifully with pocket one. If you are interviewing for a job and someone has a high school diploma and 5 years experience, and you have 2 years experience with a certification and an associate's degree, you have a great chance at favor for the interview. The more you have to fill this pocket, the better your chances at getting a job you interview for, or if self-employed, the customer base you're looking for or to achieve. For self-employed individuals, I always use truck drivers, for example. If you're trying to build your client or customer base, the more skills and licenses you have to offer, the more your customers or clients will trust you handling their services for them. This will work well also with attorneys and doctors, small business owners, etc. So after all, you wouldn't want to hire an attorney that didn't have a license in your state, or perhaps it might be more attractive for you to see a doctor when you have special situations if they're board certified. The important thing is to note is that one skill or trade becomes obsolete. When one becomes obsolete, you can continue to survive using another skill or trade. So the fourth and final pocket is your long-term assets. This pocket should be filled with long-term investments such as rental properties, retirement assets, which are 401ks, IRAs, other plans, long-term stocks, long-term financial instruments, and businesses such as purchasing a franchise, starting a business and growing it, etc. Long-term assets take many years to mature. So you're 21 years old. We don't expect you to just go out there and start and open up you a McDonald's and start to build it. That's not impossible. Sure, you can go ahead and do it, but it takes time to build these long-term assets. Many jobs offer retirement plans. You should capitalize on these plans and maximize the match portion. For example, if your job will match 4%, then you need to make sure you put in 4%. Otherwise, you'll be leaving money on the table and giving it back to your employer. Long-term assets can also be used to borrow from yourself in times of need. When you need an emergency loan or something like that, you can pay yourself back with interest instead of paying somebody else back with interest. This should always be a very last resort, however, and not your first option. And you should utilize your short-term assets first before considering borrowing from your long-term assets, because the point of the long-term is you want to build those over time, so you'll be able to have those when it's time to retire. So let's talk about understanding some basic bankings and types of accounts. There are many types of banking accounts out there because each bank may market or specialize in a different product. However, all banks and credit unions have checking, savings, money market, and CDs. Checking accounts are also called demand accounts or transactional accounts. Checking accounts are very liquid and can be assessed using checks, automated teller machines, and electronic debits, among other methods out there. A checking account differs from other bank accounts in that it often allows for numerous withdrawals and unlimited deposits. Savings accounts can be limited to 6 withdrawals per month. This is called Regulation D, and it's very important to understand this. Regulation D was set by the Federal Reserve. However, in 2020, it was lifted temporarily due to the pandemic. So you say, well, that's my money. It's my money in my savings account. Why are they restricting me from spending it? Well, the federal government does restrict 6 withdrawals from your savings account per month. So it's important to note that you understand that. So if you exceed these 6 withdrawals, a bank might impose a fee on you. They might close your account. They might even convert it to a checking account. So just be aware that you're only limited to 6 per month. A money market savings account or MMSA also come with restrictions. You can write checks off of a money market account. However, they're still subject to the Regulation D rules of only 6 withdrawals per month. So just be aware of that. CDs and certificates of deposits, that's a product offered by banks and credit unions that provides an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. So they have different types of CDs. They have some for a year, 6 months, 3 months, 3 years, 5 years. It just depends on the banking product. So balancing your checkbook. Balancing your checkbook requires that you keep track of all your transactions you've made through your checking account. You can use a checkbook registry recorded by hand using simple addition and subtraction, or you can use an electronic method such as Excel that will calculate it for you. When you're balancing your checkbook, you need to record all your checks that you've written and debits you've completed, as well as any withdrawals you made. So it's extremely important to regularly balance your checkbook, especially if you use your debit card for purchases. Most ATMs will give you a receipt with your withdrawal, but the balance shown is not always accurate. Please understand that. The computer systems at many banks take 24 to 48 hours to update, meaning that if you have an outstanding check that has not been accounted for by your bank, the balance at the ATM receipt is not accurate. And then if it's a Friday, the bank will not update your accounts until Monday night at midnight. So you won't have a more accurate balance, I should say, until Tuesday. And then if there's a holiday on a Monday, you may not have a more accurate balance until Wednesday. Not that Tuesday, but Wednesday. So keep that in mind. Calculating by hand can be used using a notebook, a check registry, or even a computer Word document. However, calculating by hand is subject to the higher probability of error. So as you can see in this particular snapshot, if you had a balance of $1,500, you made a purchase, you go ahead and calculate your purchase, you subtract $450, there's another purchase, you subtract $200, you have a bill payment. Now, if that's a check, you want to make sure that you document that as a check for $300. You had a withdrawal of $200, another bill payment, and then you transferred some money to your savings account. So your remaining balance is about $50. Now, $50 may not show up on that receipt at the ATM. Just keep that in mind. That's why it's very important to make sure you keep record of that manually. So Excel, like I was saying earlier, is a great tool to use for balancing your checkbook and eliminating most errors. I use Excel. I don't use anything else. Are there still possibility of errors using Excel? Sure it is. However, once the formulas are put into the spreadsheet, the likelihood of errors are minimized. There are other budgeting applications out there that you can access in your app store on your cell phone. Feel free to look at those. I prefer Excel because I can expand the budget from months out on one spreadsheet and save it on my desktop or use it on my cell phone if I prefer. So what I'm going to do is go ahead and show a very simple budget using Excel. So I'm going to share a different screen here. Okay, let's share this. There we go. All right. Okay, so we're going to go ahead and just create a monthly budget. So we have Excel pulled up. I'm going to create a monthly budget. Let's go ahead and make some room here. All right, and let's say you make $3,400 a month, and that's net. So we're going to have rent or mortgage. Let's say that's $900. We have utilities. Let's say the total was $450, and we're talking, let's say that's electric, gas, water, cable, internet. Then you have car payment. Let's say that's $350. You have food, $400 per month. Food's expensive these days. We have fuel. We want to go ahead and make sure that we differentiate that from regular utilities. Gas utilities. So we say, let's just say $300. That's going to definitely depend on where you work, where you're going, what kind of car you have, because we know gas prices are astronomical. So credit card payments, let's just say $100 for that. Let's say your life insurance, because you're in your 20s and it's pretty cheap when you're in your 20s for a nice, let's just say a $200,000 policy. Car insurance, let's say that's about $100, and that's going to depend on all kinds of things. You have savings, it's 200 per month, and then cell phone. Let's say that's $75. Okay, so I think I may have captured everything. Let's go ahead and make it a little pretty here. Let's go ahead and make these into money. We're going to total this out, and this is a simple formula in Excel. So you highlight this cell here, you click on the FX, and you click on sum. And as you can see, it brings up B1 colon B11, but we don't want it to include B1 because that's how much we're actually bringing in. So I want it to start on B2. So I'm going to have it start on B2, 2 B11, add those up, and that gives me $2,900. So that's the total budget. So that's a simple monthly budget. So then we're going to say, well, I get paid bi-weekly. So let's say paycheck one, paycheck one, and then we have, let's say you get $1,700 in that paycheck, and then you have paycheck two, $1,700 in that paycheck. All right, so let's make these money. All right, so what are you going to pay on that first paycheck? And what are you going to pay on that second paycheck? And we cannot exceed $1,700 for each one. So I always recommend making sure you pay your rent or your mortgage at the end of the month. That way it's on time. So when I say the end of the month, this is the payment for the next month. So it's not late. So it's going to be on time. Then your utilities, let's say your utilities card payment. Let's go ahead and make those, put those in your paycheck one. And all I'm doing is highlighting and hitting Control C and then Control V for pasting. So let's say credit card bills, Control C for copy, Control V for paste. And let's say life insurance, car insurance, Control C for copy, Control V for paste. And then if you take this cell and just highlight these, hold your mouse down and highlight them. If you look down here, you can see where you are as far as the sum. It tells you it's at $1,025. So we still have a little bit more room to go. So I want to go ahead and make sure we have room for food. Let's do 200 for food here. And then we'll do for gas or fuel. Let's do $150 for, and that's basically half. So let's go ahead and see, let's add that up and see if we got any more room. All right, that's $1,375. Let's go ahead and throw some money. Let's do the cell phone. Let's go ahead and take the cell phone, put that over there. And let's go ahead and do $100 to the savings. All right, so now we got that. Now we're going to go ahead and create a total. And we're going to use the same method that we did over here. We highlight the cell, click on FX, hit sum. And then we're going to go ahead and do H. So now we're doing H2 to H10. So H2 to H10, hit OK. So we're at $1,550. That's our budget for our paycheck one. Now let's go to this paycheck two. We got fuel, the other part of the fuel, and then we have food. Let's see, are we missing anything else? Savings. And we have the rest of the savings. That's 100. All right, so we have total here adding up to $1,350. So I'm going to go ahead and total. And then what I'm doing here is Excel is beautiful because you can just Control C this and Control V over here, and it'll just add it up for you. It'll just merge it over, but it'll bring over the calculations for this row. I love the way Excel does that. So now we have our paycheck 1 and paycheck 2. Now we have our budget established. We've got our monthly budget here, and then we know how much we're going to pay out of each paycheck. Now we need to know about our checking account. So let's say Federal Credit Union. All right, so we're going to say, okay, so far, let's see, we have a check outstanding. Let's say our check is, let's say we paid our car payment. All right, and now we made a debit or ACH transaction and paid our credit card. All right, and we know that our life insurance is coming out. That's a debit. I like to make sure I put that as a debit, either ACH debit or regular debit. All right, and let's say we also paid our cell phone bill and we did an ACH for our cell phone. All right, and then I withdrew some money. I need to go somewhere and hang out and have some drinks. So let's see, I withdrew $100. All right, so far, we got about $650 here. So what we need to do is look at what our balance is in our checking account. Got the total, put a total here. Let's say the balance in our account in checking. Let's just say our balance is whatever our paycheck is, $1,700. That's our balance. Leftover. Okay, this is our leftover section. So let's go ahead and finish this up. So this is how much we got outstanding out there. However, we still got some things we need to pay. We haven't finished paying everything. We still need to transfer some money to our savings account. We still need to pay our car insurance. We still need to pay our utilities. So this is what I usually do. Even though this is the checking account, I like to go ahead and add those items over here just so I have an accurate amount of how much I'll have left over. So let's go ahead and create the leftover amount. First, let's do our total. So we highlight this cell. We'll go to FX and we'll go ahead and do our sum. And we're going to go ahead and do B17 to B24. So it's already highlighted, B17 to B24. Okay, that gives us our total balance that we have there so far. All right, now this is our balance in our checking account, no formula required. Left over, so what's left over? So let's go ahead and use FX and we're gonna subtract B26 from B25. So it sounds like we're playing Battleship. So it's B26 minus B25. That gives us the leftover balance here. So this doesn't move. So watch how this fluctuates once I add this other stuff. So we still know we have to pay, we have to move money into our savings account. We still have to pay our utilities. And we still have to pay our car insurance. You see how that moved? Now we know how much we actually have left over for this paycheck. We actually have $400 left over that we can actually play with. So this is a simple budget, a simple way of creating a budget in Excel. I love Excel. It's very useful. It's a very useful tool. So I'm gonna go ahead and get back to where we were, so we can finish up. All right. So let's go ahead and talk about financial calculators, simple interest, compound interest, and the future value of money. So understanding how money works is very important. There are times when we will need to obtain loans for large purchases and sometimes minor ones. It's very important to understand how much you will pay for utilizing someone else's money to get things that you want. There are many factors that play a role in the cost of these loans. The biggest factor is your credit, We'll talk about that in another seminar. But for this seminar, I'll explain the cost of borrowing. So we're going to talk about simple interest. So simple interest is a quick and easy method of calculating the interest charged on a loan. Simple interest is determined by the interest equals the principal times the rate times the time period. Very simple formula. So when you make a payment on a simple interest loan, the payment first goes towards the month's interest and the remainder goes towards the principal. Each month's interest is paid in full, so it never accrues. Simple interest loans are usually your auto and personal loans and mortgage loans. However, mortgage loans are on an amortization schedule, and banks will allow for additional principal payments on those, whereas some lenders do not allow principal payments on auto and personal loans. Instead, it will only allow you to pay ahead to advance the date and lower the interest on the principal. So that's all you can do. So basically, when you pay your vehicle loan, pay extra on your vehicle loan, you're just advancing your due date is all you're doing, and reducing your principal so that when your next payment is due, you pay less interest on the principal. That's how they do it. But you can't make principal payments at any time on those loans generally. To understand how simple interest works, consider an automobile loan that has a $15,000 principal balance and an annual 5% simple interest rate. If your payment is due on May 1st and you pay it precisely on the due date, the finance company calculates your interest on the 30 days in April. So your interest for 30 days is going to be $61.64 under this scenario. However, if you make the payment on April 21st, the finance company charges you interest for only 20 days in April, dropping your interest payment to $41.09, which is a $20 savings. So because simple interest is often calculated on a daily basis, it mostly benefits consumers who pay their bills early each month. The bottom line, to make sure that you at least pay your bill on time, that's the bottom line. So not so that you don't accrue additional interest or late fees, but pay it early can save you some money. Well, compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. This is thought to have originated in the 17th century Italy. Compound interest can be thought of as interest on interest, and that sounds really good. It makes your sum grow faster at a faster rate than the regular simple interest. The rate at which compound interest accrues depends on the frequency of compounding, such that the higher the number of compounding periods, the greater the compound interest. Thus, the amount of compound interest accrued on $100 compounded at 10% annual will be lower than on $100 compounded at 5% semi-annually over the same period of time. That's because it's compounded, it has multiple compounding periods. Because the interest on interest effect can generate increasingly positive returns based on the initial principal amount, compounding has sometimes been referred to as the miracle of compound interest. Compound interest is interest calculated on the initial principal, which also includes all the accumulated interest from previous periods on a deposit or loan. So this is a highly favorable method for deposits for many investors. And future value of money. So future value of money is important to investors and financial planners as they use it to estimate how much an investment made today will be worth in the future. Knowing the future value enables investors to make sound investment decisions based on their anticipated needs. However, external economic factors such as inflation, which is what we're going through now, can adversely affect the future value of assets by eroding the value, which means, if inflation is continuously increasing, that $1 million may not be worth $1 million 10 years from now. It may only be worth $700,000. So in the current example we have here, one may want to know, how can I get to $1 million reasonably? It will take about 40 years at 7% rate with an initial investment of $5,000 at $386.17 per month contribution. This is why it's crucially important to start saving at a young age. Don't wait, start saving now. So you may say, well, where can I find a vehicle for a 7% rate? So this is where you would want to contact your financial advisor to review the different instruments that they have that will get you to that desired rate based on the current market. There are different savings goal calculators out there. I use the one at investor.gov. You can play around with this. You can put in, maybe you have an initial investment of $10,000. Maybe you found an instrument that you can that gives you an interest rate of 8%. So you can play around with the numbers and calculate how fast it would take you to get to that $1 million, depending on what you're looking to achieve. Setting your money goals. So in this example, we're utilizing the compound interest factor with an initial deposit or contribution of $5,000 and monthly contributions at $150 at an estimated interest rate between 7 and 10%. At 40 years, compounded interest would result in about $434,000 in this particular scenario. You can play around with this. Once again, this is at investor.gov. You just go ahead and do a search for a compound interest calculator, plug in your numbers and play around with it. I love these calculators. They really help you determine how much you need to invest initially, so you can go ahead and determine what kind of goals to set for yourself, reasonable goals at least. So in conclusion, this might seem obvious, but it is easy to get ambitious when sitting down to budget for the first time. It takes time to thoroughly review historical performance and identify cost drivers. So avoiding goals that are not grounded in reality is absolutely crucial. Make sure you can afford your goals at the time. One of the things budgeting and forecasting attempts to do is provide a roadmap or how to navigate the fiscal year ahead. Also, be sure to plan for emergencies by adding a layer of funds to your savings for cushioning the second pocket, as we discussed earlier. One of the major mishaps that can happen when striking a budget and forecast is the use of bad data or payment amounts. Make sure you have the correct amounts, such as your car payment. Make sure the car payment is correct. Make sure your life insurance monthly payments are correct. Utility bills can be approximated since they do change, and your credit card bills will also change depending on your balance. So make sure you're very frugal when it comes to utilizing that credit. But most other bills are the same amount per month. So create a budget for short-term and long-term goals to layer that second and fourth pockets. That's your short-term and your long-term pockets. And finally, once a budget is drafted, it's important that it does not simply just collect dust on the desk. This is a meaningful roadmap to achieve your goals. So make sure you constantly nourish that budget, check on it, review it, update it, change it. Use it the way it's designed for, and that's to set your goals and plan for the future. I would like to thank you for tuning into this budgeting and banking. I hope the seminar was helpful. The Everyday Daily Real Adult Nonprofit Learning Organization conducts several other seminars for the everyday adult navigating through life's challenges and processes. Please reach out to me via phone or chat if you would like additional information. Our organization is a nonprofit, and your contribution will allow us to continue to provide free education to our young adults and local communities, as well as be utilized to provide educational materials and information to young adults as they navigate through their learning and development process within the T.E.D.R.A nonprofit learning organization. Please visit our website for additional information about the organization and our mission, as well as learn information about our teacher and our board members. So if you have any questions or anything like that, feel free to contact me, put it in the chat, look at our website. I'm available to discuss any of this information or provide any tools that you might need. And I'd like to thank you so much for joining us and tuning into this seminar. So you guys have a great rest of your day.